Hey, I got a question in regards to my video from a couple days ago, and it had something to do with why the short-term rates were higher than the long-term rates. Normally, the longer you lend money out, the higher the interest rate should be because you're basically, committing your money for a longer period of time. So you should be compensated for that. Obviously, at this moment in time, that's flipped. There's actually a term for that, and it's called an inverted yield curve, and I'll get to that in a second and what the implications are. But the reason why the market is priced this way at the moment is because essentially the market is expecting that rates are going to go down over time. So the option is I can lend money for 2 years, let's say, and get about 4.5% a year. Or I can lend money for 10 years and get 3.5%. So why would I do the 10-year loan when I could do 2 years and get a higher rate? And the idea is the reason why people would still do the 10-year loan or bond is because they're worried about what the interest rate will be when the 2-year bond matures and they have to roll it over. So if you're getting 4.5% for a couple of years, but then when you roll it over, you're only getting 1%, okay, it might be better just to take the 10-year bond and lock in the lower rate for longer. So getting 3.5% for 10 years is better than getting 4.5% for a couple of years and then 1% for the rest of the time. So that's what the market is pricing in, is that they expect, that investors expect that interest rates will actually come down over time from where they are today. The other benefit is that a 10-year bond, if rates do go down, has much greater appreciation potential than a short-term bond. So for example, the 10-year treasury, if rates were to drop 2%, there's 18% appreciation in that 10-year bond. Whereas the 2-year bond, if the interest rates drop a couple percent, you might get 2 to 3% appreciation. That's it. So there's a lot more appreciation potential in the longer term bond. So if you think rates are going to drop, then you might believe that the 10-year bond is a better investment opportunity. Okay, on to the inverted yield curve. And what does it mean for the economy? The reason we call it a yield curve is because when you plot the interest rates for the various maturities, you plot it on a graph, there's a curve to it. So we call it a yield curve. Typically, it's an upward sloping curve. The longer you go out, the higher the interest rate. Right now, the reverse has happened where the curve is actually sloping downward, so it's called an inverted yield curve. And what we see throughout history is when the yield curve is inverted like it is today, recession tends to follow shortly thereafter. So anyway, I hope that helps answer the question of why short-term rates are higher than long-term rates and why anyone would even still bother buying a 10-year bond versus a 2-year bond, for example.